Well, good afternoon, good morning. Welcome to the daily sentiment and fundamental session with myself, Charles Cochran. Hey, TM, good to see you. Hey, Ryan. Peter, good morning. Hey, Alistair, very good morning to you. Excellent. Lovely to be here with you all. And I'm looking forward to the session. And you'll note, hey, Mark, you'll notice we have some new members from LAT with us today. So if you're joining us from LAT, a very warm welcome to you. Nice to have you with us. And if you're a regular, nice to have you with us as always. It's a really good session today because what we're going to do is find a way of navigating through this very volatile situation. Not only have we got the macro conditions of a fundamental war footing, we've also got an energy crisis, which is underpinned by a tech crisis in the NASDAQ, which is sort of underneath the layers of everything going on. And on top of that, we also have non-farm payrolls today. So we're going to make sense of all of that. Before we get started, just want to give you a rundown on how to use this session and this time and what we're actually doing here. So the purpose of these sessions is there's 5 core elements to good trading. First of all, there's trading psychology. You always need to ask yourself, should I even be trading right now? Secondly, we need to know the macro fundamental bias, and that helps us choose instruments for trading. Thirdly, understand the current sentiment, whether it's a day trade or a swing trade. And sometimes that means recognizing there's no clear bias or what the dangers are. Fourthly, technical execution. We want to keep entries as simple, repeatable as possible, and risk as minimal as possible. And finally, risk management, position size, stops, knowing your downside before you enter, etc. So what we focus on in these daily macro sessions is elements 2 and 3, helping you to build a directional bias based on macro fundamentals and sentiment, whether that's for FX, indices, metals, or crypto. Now, if you're brand new, I do strongly recommend you going through the macro fundamental course, particularly the video covering the 3-step process. You can see that 3-step process in this course. And this kind of underpins our macro fundamental framework. What we're doing to every single, there should be sound, Gavin. Check your. What you're looking for is 3 things. You're looking for the baseline, the surprise, and the bigger picture. So we'll demonstrate that today with non-farm payroll print. Yeah, nice one, Gavin. The course is through a financial source membership, David. So that's what I'll do is I'll explain the fundamental outline today so you'll get the idea, okay? This 3-step analysis process really underpins what we're doing. We're trying to understand what's expected so that we understand the surprise, and then we always ask ourselves, how does that change the bigger picture? So, simply at the moment, what's expected with the Iran situation is that the Straits of Hormuz are going to remain blocked and the conflict's going to go on for about, 5-6 weeks, right? What would be a surprise? It would be a surprise if the man of the moment, US President Donald Trump, said that's the end of the conflict with Iran and the Straits of Hormuz open up today, right? That would be a big surprise. Does it change the bigger picture? Yes, right? That would be a very clear tradable opportunity. And that works on that big level, also on the minor level with data points. That's kind of the heart of it. I won't get caught up in too much detail, but I want to outline to you what we're doing here. In terms of daily preparation, there's a few things that we look at first of all. The number one is the news feed and squawk. It's essential. It gives you real-time information, early clues about sentiment. We use the squawk, and when you're listening to the squawk, you get a feel how the session's shaping up, what major macro drivers are out there. And we've got our tools. Our tools here are the economic calendar. So if you look at the economic calendar here, you see the benefit of our calendar is you have the low and the high consensus. Now, it's all very well knowing what the consensus is, but what's the low and the high? In other words, what are the minimum that economists are projecting and what's the maximum? That helps us recognize the surprise, okay? So that helps us doing this work to understand what the surprise will be when we understand what the range of expectations are. And I'll show you that today with the non-farm payrolls, right? What we'll be looking at is what the range of expectations of all the data points is and what will be the surprise. Okay, so that'll be a good, good illustration of what we do today. We've also got the interest rate tracker, which keeps on track of the latest interest rate moves, and this provides sometimes short-term and sometimes medium-term swing trades when we see those interest rate expectations change, right? You can see here that the interest rate expectation has changed, that the markets are expecting the Fed to remain higher for longer than they were a week ago, and you can see that's been impacting the dollar. And I'll come on to that and explain that dynamic later on. We also have the implied volatility tracker. These are natural turning points based on options market data. And what you will find is that these standard deviations become major turning points. And I'm going to use one of these for the euro dollar today for a potential trade on the non-farm payroll. And I'm going to show you how we can look at getting stops down to sort of 4 or 5 points, okay, using these high probability turning points.
So just bear in mind, you have seen continued upticks across the crude complex in recent trades. So this has been gradual over the...
Okay, so that's by way of introduction. Now, the other thing we also have is the daily brief, and the daily brief is another kind of macro analyst who provides their work alongside the work I'm doing. Always good to have a number of different analysts. I read lots of analysts, and good analysts will read other analysts. It's a very normal part of the analytical process, right? Great. And the other thing that I also run an ES futures trading room in the afternoon from 2 to 4 o'clock, which some folks in this room also attend. So that just gives you a brief introduction to us. So today, right, LAT members, very warm welcome. You're joining us at a very action-packed time in terms of the macro fundamentals. Very sad from a geopolitical perspective, and lots of conflict and war going on, which is, a terrible thing. It does make it complicated in terms of the macros, but in this environment, the narrative is relatively simple. So what I want to do for the LAT guys' benefit, I want to zone you in on the main picture that's going on. So the main picture is the fact that you've got this big spike in oil prices, right? So I'm going to explain to you what impact the war's having. You've got this big spike in oil prices, and the reason oil prices are spiking is because Iran has shut down this Strait of Hormuz, this very narrow stretch of water in the Middle East, and about 1/5 of all seaborne trade travels through this Strait of Hormuz. Sorry, the detail's not very good there on the screen. And because of that, oil markets have been surging. And as it stands, there's no oil tankers going through the Straits of Hormuz at all. That's why we've got oil markets moving higher. So the first kind of macro narrative is buying oil on dips and on breakouts, looking for high tight flag patterns, looking for breakout continuations. The oil market is a clear trade idea. The macro impact of high oil prices has been seen in the bond market. Now, if you look at the bond market, this is the largest move in a whole year that we've seen in the bond market in a week. You can see that bonds are selling off. Now, you might think, well, that's a surprise, because usually you'd expect investors to buy bonds when they're worried, and surely the war will be a time to buy bonds. But it isn't, because higher oil prices are inflationary. Everything that we use, produce, when we move, it involves oil. So if oil prices are going up, that means everything we produce, everything we move is going to cost more. And what are we trying to deal with as a globe? That surging inflation we had post-COVID. So smart investors are looking at this big rise in oil prices, and they're saying, oh no, high inflation's coming. And so they're selling bonds, and because they're expecting higher interest rates to come. So we're in a situation where central banks around the world, Bank of England are going to cut interest rates twice this year. President Trump putting so much pressure on the Federal Reserve, start cutting interest rates. interest rates starting to come down, but if oil prices remain elevated for long, they won't be able to come down. That's why, if you look at the short-term interest rate market, you can see what are the interest rate expectations. The white line is the current expectations. The blue line is from a week ago. So this means now, a week ago, investors were expecting like 2 interest rate cuts in the Federal Reserve, and now it's only 1. Look at the ECB. Look at this, right? A week ago, investors were thinking, look, the ECB might cut interest rates at the end of this year. But look what they think now. They may have to hike interest rates, right? Look at the Bank of England. Look at this. Investors were thinking, okay, December, a week ago, we might get 2 interest rate cuts from the Bank of England. And look what they say now, no interest rate cuts. Do you see the problem? So investors are saying this is inflationary. That is what's created that big wobble or that big sell-off in the bond market, right? So that means from our macro perspective, this is an energy crisis. Now, you saw that in the major stock markets, right? If you look at Germany, do you see how heavy Germany's stocks have fallen and Euro stocks have fallen? That's because Europe is a net energy importer. And because Europe is a net energy importer, their stocks have been hit harder. Same with Japan. Japan is a net energy importer. So the Nikkei has been hit very hard. But the US is the biggest producer of oil. So they're going to benefit from high oil prices because they produce more oil than any other country in the world. When you add their fracking and their normal drilling into the equation. So their sell-off has been on the bond market selling off, not on energy. Whereas the DAX, Euro stocks, FTSE 100, that sell-off has been on the energy crunch and on the bond market sell-off. It's the 2 things, right? So that once you understand that, that's the big picture. So for the LAT guys, for our guys, this will be water off a duck's back. The baseline is that this conflict carries on and that there isn't a end to it for the next sort of 4 or 5 weeks. So a surprise will be if the Straits of Hormuz open up, that would be selling oil, looking for momentum trades to sell oil. That would be the dollar weakening because you'd see buyers come back into the bond markets. That would be looking to buy the euro dollar, right? There would be the 2 no-brainer trades, right? If we saw that. Also, it would be buying the DAX and Euro stocks. That would be a great equity market swing trade if we saw the Straits of Hormuz open up today, later on. With that being said, right, what's going on today? Well, today, it's a very weak sentiment because we've got non-farm payrolls coming. So this is an unusual market environment because we have 2 things. One, the condition of war, which is an obvious focus for financial markets. There are a plethora of news reports all day. You know, this drone attack into this country, there's been this response. You can't trade all those little individual headlines. So what investors are doing, they're just looking at the balance of probabilities. And the broad expectation at the moment is that the conflict is going on for about 5-6 weeks. If this inflationary spike is temporary, the market can carry on as normal. If this carries on and drags on, then we're going to see more and more pain. And that's what's going to decide this war ultimately, is going to be which side can hold out longer. Can Iran hold out and keep the regime going, right? And also prevent oil going to the market until there's too much pain for the US and the rest of the world, and they have to end the conflict because high energy prices are creating havoc in financial markets. That's the balance that is essentially going on. So what we have today, there's 2 major things to be looking at on the economic calendar. We've got 1, non-farm payrolls, which I'll look at that detail in a minute. And we've also got Fed's Waller speaking today. Let me just check the time he's speaking. Walla is speaking today as well. I'm just going to check my other calendar for that. Just 2 seconds. Okay, yeah, 12:30 UK, we've got Walla. So before non-farm payroll, you got Walla speaking at 12:30 here. And he's probably going to start talking about a pause in interest rates because of that oil spike. Expectation is that if that strait doesn't open up, the oil's going to hit $100 a barrel. That's inflationary. Fed's Waller is going to say we can't cut interest rates while that's going on. That's most likely. So that's dollar strength. So heading into the next couple of hours, there's a basic bias of dollar strength. So you can see here the euro dollar is sort of just moving lower on that dollar strength kind of narrative. But because it's NFP day, right? Just gonna grab a water, hang on, folks. My throat's got a bit dry. Because it's NFP day, you don't want to be getting into any sort of trades really, right? Because the market just condenses, and then when the news breaks, it goes. But think about it. Our market's going to be wanting to holding risk into the weekend. No, they're not. So there's going to be a bias for dollar strength, oil strength, gold strength heading into the weekend. There's going to be that broad bias because geopolitical risk. So that's going to be in all savvy investors' mind. They're not going to be wanting to, sell the dollar. With that being said, let's look at what to look at for the non-farm payroll. Let me just filter this. So we're just looking at the US data and earnings and employment. We're just going to get the high impact there. Right. So the most influential economic data point in the world, arguably, is the non-farm payroll. It's how the US economy is doing. 25% of the world's entire GDP comes from the US. How the US is doing impacts the global economy, and the US labor market data is one of the first and earliest indicators on what's going on. So, in very basic terms, if employment, right, is strong and the labor market remains strong in the current environment, investors say this is great news and they will use it to buy equity market. So you'd expect upside in the S&P 500 if we see very strong data from the labor market. Also, if the labor market is strong, it means there's less pressure on the Federal Reserve to cut interest rates. So if the labor market remains strong, there's no pressure to cut interest rates. So that should support the dollar. So the first kind of opportunity to look for is this. If we see and this is the best opportunity because it ties in with the geopolitical risk. The geopolitical risk is buy the dollar, right? The dollar's become very attractive in the current market environment. So if all of a sudden this jobs data supports that narrative, then euro dollar selling is a trade and S&P 500 buying is a trade, right? But remember what I said about those range of expectations, right? What we need to see a better than expected print. And in order to see a better than expected print, you can see the headline is expected to come in at 59,000, right? But look at the range, -9 to 125, right? So we're going to look at that and see what will be a genuinely good print. Unemployment, expected to be 4.3, but look at the range, 4.2 to 4.4. So we'll look at that to see what a good one is. And then average earnings is expected to come at 3.7. Right, so there's a couple of things to note here. First of all, whenever you see the headline print, always check the prior. The prior reading is the previous reading, and that could undermine what's in the headline. So for instance, if the headline comes in like 125,000, but the prior is revised down to 0, you see the prior completely undermines the headline. So just keep that in your mind. So in other words, what we're looking for to sell the euro dollar and buy the S&P 500. This is what we're looking for. So this is the first trade idea that I have. So here's the range of expectations. Now with the NFP, it's helpful to see that range here. And this is the headline non-farm payroll. And you can see that the majority of people are around that sort of 85, 77,000. So if we get anything above 100,000, right? You can see there's only one forecaster going for 100,000, two for 104,000, and one for 125,000. So if you look at, out of all those people forecasting, right, there's only a few up here. So that tells me one, a high print will be anything above 100,000. There's also rumors going around that because of the cold weather in January and February, that this number is going to be negative. So even in the current sentiment, 100,000 would be a surprise to the upside, and that should support dollar strength as long as we also see the following. With the unemployment rate, we want to see it at 4.2% or lower. Do you see? Because that will be a surprise. Only 4 forecasters saw it coming in at 4.2%. So write this down, folks. You want to see the headline above 100,000. You want to see the unemployment 4.2% or lower. And then with the average earnings, we want to see this coming in 3.7% or higher. Although that's the most majority of forecasters, as long as we get those 3 elements, that will be enough. All right. Headline 100,000, unemployment 4.2%, average earnings 3.7%. Then I look for euro dollar selling at market. I wouldn't be unreasonable to sell at market, take 20, 30, 40 points, and then look for breakout trades, look for continuation moves, look for momentum plays. You can apply your own technicals to that. Absolutely fine, right? You can also look for dollar yen upside and S&P 500 upside. In this environment, markets will probably be relieved, say, hooray, look, the US economy can weather a bit of difficulty. They can weather a bit of stagflation risk. The jobs market is still strong, so I'd expect the S&P 500 to rise. Be aware, though, markets are a bit shifty because there's problems with the geopolitical crisis going on with the war. Right? Okay, so that's the best opportunity. There's another opportunity, which is if we see this surprising market to the downside and seeing dollar weakness. So in this instance, I'd look to fade the euro dollar, and I'll show you where I look to fade it from. Right, so this will be the trade. Just one trade idea, but minimum risk and a large potential reward. And this is what I'd need to see. So basically, if the non-farm payroll is a big miss, you see the dollar sell off. But think about it, going into the weekend and the geopolitical risk, will markets really want to sell the dollar? They'll start buying it again. So any weak print, I would expect it to be faded. So any euro dollar strength, I'll be looking to sell that rally because of the geopolitical environment and because of high oil prices and because of the sell-off in the bond market means there's structural reasons for more dollar buying to come in. So if I see, right, this print is weak enough, right, I wouldn't want to go with it. Right now, you could, if we saw the following, you'd want to see the headline about 30,000 or lower. Yeah, if the headline comes in about, I would say today, you need to see the headline negative. So you need to see a negative number of jobs added. You want to see unemployment coming in at 4.5%, right, or higher. So a complete surprise, blowing out the water, all forecasters surprised. And then you want to see average earnings. You want to see them coming in at like 3.4% or lower. So a complete surprise right across the board. Let's just show you. So we want to see unemployment 4.5% prior, unrevised or revised higher, minus 10,000, right? Or and the prior unchanged or revised lower, average earnings 3.4%, and the prior unrevised or revised lower. So a complete washout, right? That would, right, give you an opportunity to very quickly go with a euro dollar long. But where I'm looking to fade any euro dollar strength today from this 1.1658. And I'll show you what I'm looking for. I'm looking for the 1.165 option turning point. This is an obvious turning point in markets, and it's also a liquidity area. So a lot of stops, right, are just sitting above that level. So if we go up into there, that's a great area of liquidity to potentially look for fresh shorts on a stop hunt. Now, we took a trade earlier this week on Tuesday, very similar, just to give you a little bit of inspiration. And where was it? I think it was from the 7-2 region. It was from there. We had a 4-5 point stop and we ran it all the way down to 1.155. It was actually better than that. It was actually this level. I think it was at 712, where we had like a sort of 36 risk reward winner, right? So I'm going to show you that same principle today. So the one area I'm looking for is here, this 1.165, and the way I play it is I've got a 5-point stop only. Now, you might look at that and say, well, that's stupid, right? Because you're not giving the trade any room. But the way I play these is, say price comes up to here, right, and stops you out, I immediately re-enter with exactly the same parameters. And then I'll try a second time and up to 3 times. So what I will risk here, right, is 15 points risk total. What I'll say is come up to this area, right, and enter short 1.1658 with a 5-point stop. If the first attempt is stopped out, I'll try again. If the second is stopped out, I'll try again third time. And then if the third time is stopped out, I'll quit for the day. But I'm looking for that if we see any euro dollar weakness. And if there's even, just see if there's an even better area here technically. That would be, ultimately as well, on a day like this, as long as the macro conditions remains as they are, I tried exactly the same from this level here. Again, 5-point stop. Yeah, so that risk is up to you, Simon, but I would say probably something about like 0.33% per trade. 0.25%, something like that. So that would mean that say you get hit 3 times, you've lost 0.75% in total. That's not unreasonable, Simon. As a ballpark, obviously find your own risk parameters, but something like that is what I'd be using. Yeah, basically. Yeah, that's very reasonable. Okay, folks, it's been lovely to have you. Now you're welcome, Simon. LET guys, lovely to have you here today. I hope that's been insightful, and I hope you've seen something as well as a good potential trade idea for the day. And for the regular guys, good to have you here as always, and I look forward to seeing some of you later for this session. Yeah, see you later, Ryan. Yeah, you're very welcome. Yeah, cheers, guys. Take care. Remember this 1.1658 level. That's the level for today. Just check with support, Daniel. I can't remember what the current price is. I'm sorry, Daniel. I mainly focus on the analysis, right? Yeah, Peter, 1.1658. Right, have a look at it. So 1.1658 will be the area that I'm looking at, right? And then if you get the other thing to look at is say you get very strong. We'll just leave it like that for today, okay, folks? I don't want to overcomplicate it. All right. Cheers, everyone. See you later. Bye.